Hi, this is Mike Maloney, adding yet some further insights into another great article by Jeff Clark. And this one opens up with most price forecasts aren't worth an umbrella in a hurricane. And having been in Puerto Rico for a hurricane, I can tell you that an umbrella does you no good. However, there are some things that you can glean from it, and it's worth taking a look at. And so going right down to the various price predictions that Jeff takes a look at here, we've got the thing to take a look at is the average price projection. Where is it? 3,000, 3,000. My friend Dave Morgan of the Morgan Report, 2,200 to 2,400, up 20%, between 2,500 and 4,000. Sprott Money says 2,100, 2,250, 2,800, 2,425, 4,821, 21, not 4,820, but 4,821 by 2030. So that'll be interesting if that is the absolute peak by 2030 is $4,821. I don't like giving, so this is Ronnie Stofferle, and Ronnie is a friend of mine, great guy, good at analytics, but they're going off of, this is the results from a spreadsheet, I can guarantee you. So Peter Spina, $2,700, 1,831 as an average. So this is the only price in here that is below today's prices. And a $2,150 high, and this is a survey of mainstream banks and institutions. So that is the mainstream. 5,000 in the next move, toward 5,000. 4,000 in the next 3 years, 1,920. $2,100 here, $2,000 there. On the average, these are all higher than where the price is now. That's one thing that is important. But last year, gold pretty much just broke even. It didn't really go up or down. It zigzagged back and forth during the year, but it ended the year about where it started the year. And so that seems like lackluster performance, but it's not. And I'll tell you why. That's coming next. First of all, Jeff talks about inflation and the Fed's, which I think it's insane to have a 2% target right now after adding 40% to the currency supply. They are not going to be able to achieve this 2%. They need to allow inflation and the rest of the economy to catch up to the bubbles that they created. And so this is insane, and they will burst the bubbles that they're going to create some sort of emergency, some crisis. So that target is still far away. We peaked at 9.1% on the CPI, and we're down to 7.1%. Now, if you take a look at my last two videos of last year, I very comprehensively give you an outline of the scale of the bubbles that we are in, and how the Fed is going to create the next, they're trying to do a Paul Volcker. Paul Volcker typically had the Fed funds rate at double CPI inflation. So this would require 14.2%, double or more, sometimes even 3 times. So up to 21% Fed funds rate, which is impossible today because of the national debt. Gold usually positive during recessions. And one of the things I want to point out is so many people use like monthly data. This is monthly data because it shows gold's peak at about $630 here, where we know that $850 was the widely publicized peak price, but it actually had an intraday high on the Chicago Board of Trade of $873. So this is monthly data. And it shows you how strong gold has been lately, that on monthly data, we're up here approaching $2,000. It surpassed $2,000, but not on an average of any month. This is the reason that the Federal Reserve is absolutely trapped, and the reason that we're sort of at there's going to be a big shift coming. There will be. There has to be. And this is one of the reasons. This monetary system that we're on, we've now got about 32 trillion in national debt, and you can see that the interest payments have spiked to all-time highs. And this is just the latest data point or two. And I don't know if this is quarterly or biannual data here. But so in the past year or less, this has suddenly spiked. Well, the national debt rolls over every 4.5 to 5 years, roughly 5.5 years, that range. And so it's basically like refinancing your home. You want to refinance, it's going to be at whatever the current interest rates are. And so the interest rates have gone up dramatically over the past year. And so this spike is only since the interest rates have been raised, which was last March or something when they started raising them. So it's less than a year ago that this, and it still has, so less than 1 year out of the 5 years of rollover has been completed. So it's got this is maybe 1/10 of the amount of the national debt has already caused this spike. What happens when the other 9/10 hits? It's going to be an absolute disaster. Time between rate hikes and cuts, and they're going to keep on slamming the interest rate up until they cause a crisis, and then they'll bring it down to zero. The gold during the biggest stock market crashes, and so here you've got all of the biggest stock market crashes going back to 73, 74, and gold's performance during all of those. And there's only one where gold actually fell more than the stock market, and that's because gold had just hit its peak in 1980, so it was coming down off of its peak. These two yellow ones are where gold fell, but it fell far less than the S&P 500. The reason that this is important is last year, gold sort of broke even. It started and finished the year right in, within a few bucks. And so the stock market fell 18% over that time. So let's just try to eliminate the dollar from the equation here and see what that actually means, because gold, people say, oh, well, gold didn't do anything last year. Yeah, but real estate is down, stocks are down, bonds are down. When the yield goes up, the price goes down. So if you were holding on to existing bonds, they're not worth as much in the aftermarket because they don't pay as much interest. And so all the other major asset classes fell. Cryptocurrencies, they're all down. So everything is down. Gold broke even, silver rose, but I'm going to just focus on gold because that's what the central banks hold. It's more, even though silver has been used as money many, many more times throughout history than gold, gold is still considered the standard of money when it comes to central banks and such, when it comes to nations throughout history. And so if the stock market, let's use some hypothetical numbers here. Let's say you have $1 worth of gold and $1 worth of stocks. And then the stocks fall by 50%. Well, your $1 worth of gold that didn't go anywhere, it's still $1 worth of gold, can now buy twice as many stocks. So that 50% decline in the stocks added up to a 100% gain in the value of gold compared to stocks. Now, let's say the stocks fall by 50%, and a 50% retracement is very common in a big stock market correction or pullback. A crash can be a whole lot worse. 70% correction in value during the invisible crash from 1966 to 82. And I think it was, I can't exactly remember, but it was right around 90% that the value the stock market lost from 29 to 1932. So a 50% correction or pullback is quite normal. The NASDAQ lost like 70 something. 38% retracement, 50% retracement, 62% retracement. These are the most common corrections that you see in the stock market. But let's take that 50%. The stock market falls by 50%. Well, if gold goes up by 50%, 50 plus 50 doesn't equal 100. If gold goes up by 50%, now you've got gold worth $1.50 and the stock's worth 50 cents. So you can now buy 3 times as many stocks. In this case, 50 plus 50 equaled a 200% increase in the value of gold compared to stocks. Not the price. Forget the price. The price means nothing. What can you do with the proceeds? The price is just a number you put on it as you temporarily use currency as a medium of exchange. And so I want to move on from this. There's a chart in here with some technical analysis, adding it all up, and the predictions, minimum high 2100. For next year, I would agree that that's sort of a minimum. Potential with no crisis, 2250, I don't know. Potential with a crisis, 2700. Well, here I'm going to disagree with Jeff because it all depends on the scale of the crisis. If this is like an Armageddon-style crisis, then this range here of 3 to 10,000, that is achievable in a single year. If it all depends on how scared people are, and that's it. Likelihood gold is higher, about 90% likelihood that it's going to be higher than it is now. I think that that's probably accurate, but one of the things that this is leaving out is what is the likelihood that the stock market is going to be lower? And that's probably like an 80% likelihood. So now you've got a likelihood of 90% for the gold upside, 80% from of the stock market's downside, and looking at that value change. It isn't as important of just one of them going one direction or another, but when both of them are going opposite directions, these magnify your potential losses and gains depending on where you are, what you're invested in at the time. So let's move on from Jeff's article and take a look at some of the factors affecting this. And if you look at those last 2 videos of last year and the first video of this year that I did, it isn't as much the amount of change, but the rate of change that is going to be the big problem that's going to cause the huge crisis. And there will be a crisis. And what will happen is when this emergency that they did not see coming happens, they will slam rates right back down to 0. And that means anybody that just purchased bonds will have this one last pop where those bonds go up in value because they're paying, right now, Fed funds rate is over 4%. And they take that down to 0, and those bonds that were issued at 4% are worth a hell of a lot more to people than a bond that is paying 0.25 or something like that. But look at the rate of change compared to Alan Greenspan. This is over more than a 2-year period here. He started raising rates very slowly and methodically. And then Ben Bernanke took over and completed it. And that caused the global financial crisis. Then Janet Yellen started raising rates and Jerome Powell took over. But slowly and methodically over more than a 2-year period, and that caused a meltdown in the repurchase agreements markets and a crisis. And so what is happening this time? There is the rate of change again. And this was the rate of change. The reason it's steeper here and then sort of falls is because when you go from 1% and you raise rates by 0.5%, that's a 50% increase. If you're up at 10% and you raise rates by 0.5%, that's a 5% increase. 50 is a lot bigger than 5. So that rate of change diminishes over time when they're doing these nice, easy steps. This is one of the things that the Fed didn't look at. They just started slamming things up at a certain percentage increase with each step, where they should start with much smaller steps and then increase the size of the steps so that the percentage change is not that different. This is the rate of change of that caused the crisis in the repo markets. And then this is the rate of change today. Nothing like this has ever been done. It will cause a crisis because this is just beyond reckless. And the Fed does have other options. They increased the M2 currency supply by 40%. Well, they can contract it by causing fewer loans that are being made than are being paid. And they can do that by increasing the loan requirements, making loans a little bit harder to get rather than increasing interest rates and causing the whole system to break. But they are hell-bent determined on crashing the economy because that is what this will lead to. And what does that lead to when people panic, when there is a crisis? They run towards safe haven assets. Well, because of the FTX scandal, there's still a dark cloud over the crypto space. Bonds, like I said, they will get this last safe haven pop because interest rates, when they plunge, the value of bonds on the aftermarket increases. So where is the other safe haven? It's gold and silver, and that is about it. And, you know, people that are in my insiders, the insiders, people that have bought they've purchased a certain amount of gold or silver from GoldSilver.com. Get my insiders updates and action alerts. And whenever I make a purchase, I show them why. And I show them things like this. And here, is the weekly transparent gold holdings. So it's all of the repositories like the Commodities Exchange, mutual funds, and ETFs. All of the reporting repositories that are sitting on a pile of gold somewhere. And so we've got the gold price in gold in the background here, and then the millions of ounces in the repositories in the foreground in blue. And what you see is some waves and cycles, inflows, outflows, inflows, outflows, inflows, outflows, inflows, outflows. But over the long term, you also see that this was about even back here, and then there was a very positive bias for a few years here. And then with the exception of 2022 here, we've had a very negative bias with outflows most of the time, taking the from gold's peak back here in late 2020, as far as not the peak in price, but the peak in number of ounces being held. There's been a significant outflows. But look how this is shrinking and sort of looks like it's about done. And even though we've had outflows, the price of gold has been rising. That is very, very interesting. The next chart is the cash position. So this is the amount of dollars that are flowing in and out. So the weekly cash flow. And you see the same pattern of inflows, outflows, inflows, outflows. But here you see this sort of equilibrium back here, a net positive, and then a net negative with the exception of this blip again. But that is shrinking, and it hasn't really gone positive yet, but gold has been rising. So this is some very good news. Then we take a look at silver. Same thing, sort of an equilibrium back here until mid-2019. And then it's got a positive bias until early 2021, and then a negative bias from early 2021 until today. It's had a couple of little positive spikes there, but in large, for more than a year, it's been, about a year and a quarter, it's been significantly negative, and it looks like that is over with. But look, we've had mostly negative ounces coming out of the repositories while the price has gone from 18 to 24. And then we take a look at the cash flow. Same thing. Almost equilibrium back here, a net positive here, and a net negative here. And that appears to be over with. And even though there's only a few weeks here where there was more cash coming in than out, most of the cash was coming out, but the price rose. So these are all very, very good signs. I want to thank Jerome Blockland for tweeting this. Central banks have been buying gold at an unprecedented pace. Is the freeze of Russia's central bank assets to blame? Potentially big implications for global financial markets. And this is what this is. This is the net buys or sells going back to 2008. And what is interesting is the net buyers are mostly in the East and the net sellers are in the West. So it is a transfer from East to West. And I would just want to show you gold's performance since 2002, and it's been pretty darn spectacular. We're down here at about 250 something, and we're about, I believe that this year, if we see new highs, that's when gold gets in the news. That's when everybody starts buying again. That's when your neighbor starts talking to you about investing in gold. And so I just want to close with this little meme here. And I want to thank you very much for watching. But Currency Wars, are we winning? Thanks for watching. We'll see you next time.